Welcome to the Deep Dive. We're here to cut through the noise and get straight to the insights you really need.
Especially in finance, right? Things change so fast.
Exactly. And for insurers, managing risk is, well, it's a constantly shifting target. Today, we're looking at EIOPA's latest insurance risk dashboard. Think of it as your map.
A very current one.
Yes, absolutely. Our job here is to pull out the key stuff from this new dashboard, the July 2025 one. We're focusing on what it means for you, the risk manager in insurance. It's not just a summary. It's more of a strategic look ahead.
That's right. And this dashboard, it's grounded in Q1 2025 Solvency II data. You know, the framework ensuring insurers have enough capital buffer.
Right, the bedrock.
Precisely. And it's mixed with Q2 2025 market data, so it gives us a really almost real-time picture. The big takeaway from EIOPA, the European insurance sector's risk landscape is generally stable, sitting at a medium level.
Okay, stable and medium sounds. All right.
Well, yes, but, and this is the crucial part you need to flag, there's a negative outlook hanging over certain areas for the next 12 months.
Ah, there's the catch.
Yeah. It's mainly down to the usual suspects, geopolitical tensions, fuzzy trade dynamics, and markets just being volatile. It's a complex global picture.
So this dashboard is like a health check.
Yeah.
Beyond that stable but watchful first impression, what's the main picture it paints?
Well, what's really useful is how EIOPA breaks it down. They use a whole set of indicators to summarize the risks and vulnerabilities.
Pulling data from
loads of places.
Mm-hmm.
Solvency II data from over 90 insurance groups. And, get this, more than 2,000 individual firms, plus the latest market data.
Wow, okay. Comprehensive.
Very. And as you said, the overall picture is stable at medium, but I mean, that doesn't tell the whole story. For risk managers, the real focus needs to be on those specific negative outlooks EIOPA has pointed out for the year ahead.
Right. Let's get into those then. Maybe start with the big one. Macroeconomic risks. That sets the scene for everything else, usually.
Good place to start. So macro risks are rated stable, medium level, but, and here's that key distinction again, the outlook is increasing risk.
Increasing. Okay.
It's subtle, but vital. We saw inflation forecasts come down a bit, which sounds good, but it happened alongside global GDP growth forecasts being trimmed back. We're talking less than 1% growth expected over the next year.
Not exactly booming.
Not at all. And long-term interest rates, policy rates, both dipped slightly. Plus, government deficits widened a bit towards the end of 2024. Add in the ongoing uncertainty from conflicts, messy trade situations. It all weighs things down.
So for a risk manager, that means maybe don't count on that smooth economic landing just yet.
Exactly. Those assumptions need careful watching. It's getting bumpier.
Okay. That fragility makes sense even with a stable tag.
Yeah.
What about market risks? Always feels like a tricky area for insurers.
Yeah, market risks are definitely marked as elevated, and the outlook here is clearly upward risk.
Upward, okay. Why?
Well, a big factor is the persistent volatility in fixed income markets. That's tricky when you hold a lot of bonds, like insurers do. Mm-hmm. There's also this potential disconnect people are talking about between what equities are valued at and the actual company fundamentals. You know, maybe some stocks are a bit overpriced.
Bubbles.
Well, maybe not bubbles, but perhaps some froth. And real estate is a mixed bag. Overall, prices improved, but commercial property values still lagging way behind residential.
Interesting split. And insurers' own holdings.
We saw their median bond exposure dip just a tiny bit to just over 50% of assets, and equities ticked up slightly.
So a small shift towards equities. Yeah. Maybe looking for better returns.
Could be. It's only a small move, but it might suggest that subtle hunt for yield. Something risk managers need to think about for their own portfolio strategy, definitely.
Yeah. So we got the wider market currents, but what about liquidity? Cash flow can be the real pinch point, right? What's EIOPA flagging there?
That's a really critical area. Liquidity and funding risks, they're assessed as stable overall, but honestly, there are some mixed signals that need a close look.
Like what?
Well, cash flow sustainability actually got better in 2024, which is good, but the ratio of liquid assets insurers hold, that dropped a couple of percentage points as a share of their total assets.
So less readily available cash on hand, relatively speaking.
Kind of, yeah. And lapse rates, meaning people stopping their policies, are still stubbornly high. They actually increased a bit more in 2024, up to around 5%. That's a potential drain on cash flow that needs watching.
Got it. Any other big risk categories we should quickly cover before we dig into solvency and the newer risks?
Sure. Credit risk looks pretty steady. Risk premia haven't moved much. And the credit quality of what insurers hold is still really high, think AAA rating on average. So low default risk there. Household debt in the Eurozone even dipped slightly.
Okay, positive on credit then.
Mostly, yes. Financial interlinkages, how connected insurers are to banks, governments, etc., also largely unchanged. Exposures seem steady, though they are ceding slightly more premiums to reinsurers.
Sharing the risk a bit more.
Seems like it, yeah. And insurance-specific risks look okay, too stable at medium. Premium growth was strong last year, both life and non-life, and the non-life loss ratio improved, suggesting underwriting is getting better.
And market sentiment. How's the market viewing insurers?
Cautiously optimistic, generally seen as quite safe, though non-life insurers seem to perform better in stock market terms than life insurers. So yeah, a bit of a mixed bag even within that overall stability.
Right. So we have this broad picture, mostly stable, but with these definite warning flags waving. Where does EIOPA land on the absolute core for insurers? Solvency and profitability, especially thinking about Solvency II. For you listening, this is often the bottom line, right?
Absolutely. This is where it really hits home. And it's crucial to remember this whole EIOPA dashboard, all these risk scores, they're built on the Solvency II framework. That framework dictates the capital insurers need to hold to stay sound.
So these indicators are directly tied to that regulatory health.
Exactly. And the solvency and profitability indicators, they're assessed as stable at a medium level, which honestly is pretty good news. It shows the framework is helping maintain resilience.
Stable and medium, that sounds reassuring. What are the details? What specifics should our listeners take away?
Well, capital levels across the sector look strong in early 2025. Now, the median solvency ratios did dip slightly, just a few percentage points down for both groups and solo firms.
A slight dip. Cause for concern.
Not major concern, no, because the underlying strength is still clearly there. Even with those small drops, capitalization is robust. It shows resilience under Solvency II. Returns on assets and premiums were generally up, though some other profit measures slipped a bit.
And non-life versus life.
Non-life underwriting definitely strengthened. You see that in the improved combined ratio, which is good. And life insurance investment returns held steady.
So for a risk manager listening, what's the message?
The message is, the industry benchmark looks solid, well capitalized. But that slight dip in ratios means you absolutely need to keep a close eye on your own institution's numbers. Use this data as a benchmark, but stay vigilant on your specific capital adequacy.
Okay, makes sense. Now, this is where I think it gets really fascinating looking ahead. Beyond the traditional stuff, EIOPA is putting a big spotlight on two areas really changing the game, ESG and cyber risks. How are these moving from just operational issues to core strategic concerns?
That's exactly the shift we're seeing. It's spot on. These aren't just background noise anymore. They're becoming central to strategic risk management, how you build portfolios, even how you underwrite business. Let's take ESG first.
Yeah.
EIOPA rates ESG risks as stable overall, but here we go again with an upward trend in risk predicted for the next 12 months.
So stable level, but worsening outlook. How does that work? What's driving the worsening outlook if the current level is stable? That seems a bit contradictory.
It does sound it, but it's about the direction of travel. Think of it like the car's speed is steady, but it's heading towards a steeper hill.
Okay. Pretty safe.
So what we saw was, yes, insurers increased their holdings of green bonds. Median exposure went up to nearly 8% of their corporate bonds. That's positive.
Right.
But their holdings of other types of climate-relevant assets actually went down slightly. So it raises a question for you as a risk manager. Are you really greening the whole portfolio or just adding specific green labels?
A deeper question than just the green bond number.
Exactly. And physical climate risks, particularly windstorms, the frequency hasn't changed much, but the sector's overall exposure to windstorm damage is notably higher.
More assets in harm's way.
Potentially, yeah. Insurers' own ESG scores haven't changed much overall, though the GE part, the environmental scores, did show some improvement. So for risk managers, that upward trend in outlook is a clear signal. Get proactive on ESG.
It's not just box ticking anymore.
No way. It's about really questioning portfolio alignment with climate goals, properly assessing physical risks like storms. It's about preparing for a different future.
Okay, that's clear on ESG. And then the other big one. Cyber and digitalization. Feels like we hear about breaches constantly. What's the dashboard showing?
It really does feel relentless, doesn't it? And yeah, cyber and digitalization risks are rated medium level, but again, with a definite increasing trend.
What's behind that increase?
Supervisors are reporting they perceive a higher likelihood of incidents now. They're more concerned about IT system weaknesses. Negative sentiment around cyber has also ticked up a bit.
Even if actual attacks haven't spiked dramatically.
Right. The global attack numbers were fairly steady in late 2024, but the crucial thing for insurers is this dual challenge they face.
Dual challenge.
Yeah. One, their targets themselves, right? Big companies with lots of data and money, prime targets for operational risk. And two, they're trying to underwrite cyber risk for their clients, which is getting incredibly complex.
So they're exposed on both sides.
Exactly. It adds huge layers to risk management. So for you, the risk manager listening, the message is urgent. You need rock-solid internal IT security, obviously, but you also need a really deep understanding of this evolving cyber insurance market, the products, the liabilities.
Especially with the current geopolitical climate adding another layer of threat.
Absolutely. It's not just an IT issue, it's a major strategic risk now.
Okay, so we've covered a lot of ground: macro, market liquidity, solvency, ESG, cyber. Let's try and pull it all together. What does this really mean for you, our listener, the risk manager in an insurance firm? How do you take these EIOPA findings and actually use them day to day or in strategic planning?
Right, let's connect the dots. Think of this EIOPA dashboard as a really valuable benchmark and an early warning system for your own risk profile. First off, solvency is the foundation.
We talked about the stability there.
Yes, the sector's capital is strong overall, which is good. But remember those slight dips in the median solvency ratios. And EIOPA also notes a bit more variation in the quality of capital different firms hold. So, job number one is continuous monitoring of your own solvency ratio and the quality of your capital, especially Tier 1 under Solvency II. The overall stability is reassuring, but don't get complacent about your own numbers.
Vigilance is key. That seems to be the watchword.
It really is. Second point. Proactive ESG integration. That upward trending outlook isn't just a suggestion. Integrating ESG properly into your risk frameworks is basically non-negotiable now.
Moving beyond just reporting.
Absolutely. You need to be assessing transition risks like your green bond strategy versus broader climate assets and physical risks like that windstorm exposure much more deeply. This probably means more sophisticated modeling, better scenario analysis. It's got to be embedded.
Okay. And third takeaway.
The dual cyber threat.
Right.
That increasing trend means you need a truly holistic approach. It's not just about beefing up your firewalls.
It's internal defense and underwriting.
Exactly. Fortifying your own systems and really getting to grips with the complexities and liabilities of the cyber insurance products you offer or might offer. And remember, the geopolitical angle just makes this even more critical. It needs C-suite attention.
And I guess a final point is not to get too focused on just the headline stable rating for some areas.
Precisely. You nailed it. Even risks labeled stable overall, like macro or market risks, have those negative outlooks simmering underneath in specific spots. Remember the commercial real estate lag, the fixed income volatility. So you've got to dig into the details. Don't let that medium-level stable assessment lull you. Those little outlook arrows EIOPA includes, those are your real pointers for where to focus your attention and resources.
That's a great practical takeaway. So thinking about all this, what really stands out to you from these insights as you consider your risk strategy for the year ahead? So summing up, it feels like the European insurance sector is showing good resilience, overall stability at that medium risk level. But wow, it's definitely navigating some choppy waters.
Thanks.
EIOPA's dashboard is it's a really useful chart highlighting those increasing challenges, especially around ESG and cyber.
Yeah, the core message is pretty clear, I think. Vigilance, close monitoring, they're essential because those geopolitical, market, and operational risks aren't going away. And those negative outlooks EIOP flagged, they're the real call to action. Applying these insights proactively, well, that's going to be vital for risk managers trying to stay compliant and resilient.
Definitely. So maybe a final thought to leave you with. As risk managers, you're always balancing the present with anticipating what's next. We've talked a lot about ESG and cyber risks separately and how they're growing. But what about where they might converge?
Interesting point.
Think about things like, I don't know, the integrity of climate data needed for ESG reporting or the cybersecurity challenges around new green technologies. How might that intersection of ESG and cyber reshape the risk landscape you face in, say, the next 5 years? Something to definitely keep chewing on as you navigate this complex world.